Welcome to the MUFG Global Markets Podcast. I'm your host, George Goncalves, and today I'm joined by Glenn Schultz, the head of Agency Mortgage Prepayment Modeling for MUFG. Today is Wednesday, November 8th. Welcome to the podcast, Glenn.
Hi, George. Thanks for having me on the podcast.
Great. So let's jump right into it. Let's start by reviewing the October remittance data, which was released on Monday, November 6th. The aggregate prepayments as measured by Fannie Mae 30-year cohort reported a negative 3.8% month-over-month decline to a 4.9 CPR, and the 15-year prepayment declined a negative 3.6 month-over-month. Overall prepayment declines have been less than what's been implied by the business day count convention, which was around negative 5% month-over-month. And as you noted in your recent monthly prepayment commentary, the 30-year mortgage rate ended October up 44 basis points higher than September, which in turn pushed your models driving the mortgage rate higher also by 33 basis points. So what are your thoughts on this month's remittance report and agency prepayments going forward?
Yeah, sure. In terms of prepayment, aggregate prepayment going forward, we believe that coming through the winter months, we'll probably see aggregate prepayment speeds fall into the range between, let's say, 3.5 and 4.5 CPR in the winter months. So, that's a function of both seasonal factors and obviously a very high mortgage rate, right? And so essentially, I believe with respect to the seasonal factors, we're going to see a prepayment pattern that is largely going to be a replay of the previous year. So what does that mean? That means we're probably going to see higher turnover. This has been, a theme that has kind of worked for us over the year, and I think we'll probably still see, higher than expected turnover going into the winter months, right? Now, I think there will be a sharp difference in turnover rates between new, moderate, and seasoned production, with moderately seasoned pools reporting a higher turnover than, say, either the new production or the seasoned production. So, that's going to put a positive to kind of that 31 to 59 and 49 WALA bucket.
Thank you. So given those views, what stories do you like in the agency MBS market?
Yeah, so we have been advocating 3.5, and 4 coupons in the moderate and moderate high loan balance sectors. And that has worked really well through most of the year. Now, that said, the 3 through 4 coupons over the last 2 months or so, they have, underperformed modestly, as the market has kind of positioned around the recent, rate moves, right? But that said, we believe that the generic moderately seasoned pools, as I said, while at 31, 49 months across the belly of the stack, those are going to offer, I think, superior relative carry over the winter months and into the spring home selling season. So again, based on our turnover thesis, that does imply, that we want to be in the 3 to 4 sort of coupon range. So we still very much favor kind of the belly of the coupon stack, if you will.
That makes sense. So, like the previous month, you're still looking for strong turnover stories to boost carry, right?
Yeah, you're right. Yeah, we're still looking for the strong turnover stories. I think it's a little bit of a, I get it, it's a little bit of a broken record. You're going turnover, stronger turnover, but that's really kind of been carrying the day, right, throughout the year. And I think it's going to carry the day going into the winter seasonals as well. So, as you see the slowdown, superior carry is obviously going to come from either stronger than turnover in the discount coupons, or it comes from weaker than turnover in the premium coupons. But right now, based on the configuration, of the coupon stack, where prices are, the level of interest rates, it's really kind of a one-sided play, this year in the direction of stronger turnover towards the discounts as opposed to less turnover to the premiums. So overall, the stack is, it's a little bit different than what people are used to seeing in terms of price distributions, but it's one of those few instances where the configuration of the stack and prices, coincide or intersect with this stronger than turnover. So, for MBS investors, I think that's a bit of a blessing, right?
Got it. And what about specified pools, and those stories? Do you have any opinion away from TBA generics?
Yeah, in the specified pool sector, I really still favor, kind of the Florida pools. They've consistently exhibited stronger than turnover. And I expect that trend is going to continue through the winter months. So, again, we're looking at that 3 to 4 belly of the curve. TBA generics, I think, are gonna turn in pretty good carry based on where we think prepayments are going to be there. I think the Florida pools are going to be the standout story as we work our way through the winter months and into the spring home selling season. So, I am shifting my focus, if you will, kind of from the moderate high loan balance in the spec pool, being more focused on Florida, which we have advocated Florida throughout the year as well, but I guess I'm a bigger advocate of Florida right now.
Makes sense. Let's move on to everyone's favorite topic, and including myself. I mean, we always look at the basis also from the macro strategy point of view, and you've put together a pretty good run also of basis forecast yourself, but it does seem like the basis hasn't been fully cooperating, although it's more like the overshot that happened, but maybe there's a turn coming here. So, what are your thoughts here on the basis?
Yeah, you're right, man. I mean, I was really enjoying a good run on the basis, really up to the SVB failure, right? So my view on the basis, going into the year, and I've said this before, was really anchored in our 2023 net issuance outlook. And we're going to come in around the 400 billion, and that's a very, very low net issuance number. And so as we started out the year, we believed with that supply demand technical, would outweigh kind of the curve and the volatility, right? Our view really didn't pan out on the basis, largely due to, what seems like this never-ending conga line of black swans, right? This year it just keeps coming and coming. And as a result, the current coupon basis traded most of the third quarter at or near 180 basis points. Now, when you look at the history of the basis, that's usually reserved for, periods of market stress or illiquidity, so pandemic, global financial crisis, those types of things. But we did have a dramatic move in the basis last week. And right now, we're at a 20-week moving average, which was about 170. So we had a little bit over a 10 basis point move in the mortgage basis in 1 week. Now, the lower end of the Bollinger range, which I look at, that's just shy of 160 basis points. And that's 30 away from our upper end of our forecast, which was 130 basis points. Unfortunately, we don't have that many trading days left in the year. So, at this point, the upper end of our target, is unlikely. That said, the market has demonstrated significant moves in the current coupon basis that are sufficient to hit the upper end of our target since mid-2022. So, arguably, it's a low probability for the year. But it's not completely off the table if sentiment shifts. That said, we are probably going to end up on the wider end. We're going to probably end up outside our upper end of 130 basis points. But my feeling is that we're going to close out this year with an excellent setup for agency MBS to outperform in 2024.
I'm with you on that, and as kind of an early preview, we're going to be working on that together for the 2024 outlook, which you've been contributing over the years. So look forward to what you submit for the upcoming 2024 outlook. So on that note, we'll wrap things up with this month's MUFG MBS Global Markets Podcast. Please rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research team.